Folks, in this part of our research, we will see impairment of investments in subsidiaries, continued non-compliance and highly probable overstatement of profits, by Core. In this section, we will see how the company is constantly doing non-compliance of Accounting Standard 28, that is impairment of assets, and not testing this investment for highly probable impairment loss. But before that, let us understand the requirement of Accounting Standard 28. Accounting Standard 28, that is impairment of assets. If actual net cash flows or operating profit or loss flowing from the asset are significantly worse than those budgeted, then an enterprise is required to make a formal estimate of recoverable amount of asset. In case carrying value of assets is greater than recoverable value, then difference between the two will be equal to impairment loss on that asset, and same will be charged to profit and loss account. An enterprise is encouraged to disclose key assumptions used to determine the recoverable amount of assets. Friends, we have summarized the investment made by Core in subsidiaries, in form of equity and loans in last 4 years. We have also summarized the year-on-year return on these investments, in form of interest and dividend. As you can see that, cumulative investment in subsidiaries is constantly increasing and standing at Rs 1,410 crore as on March 31, 2013. On the other hand, the maximum return on these investments is just 3.29% with an average return of 1.2% per annum. Seeing this, one can conclude beyond doubt that company must not have budgeted so low return on funds invested in subsidiaries in any of the last 4 years. Core has 1. Not booked any impairment loss in financial statements of financial year 2012-13. 2. Not disclosed in accounting policies that an estimation of recoverable amount of assets will be made, in case the actual net cash flows or operating profit or loss flowing from the asset are significantly worse than those budgeted. 3. Failed to show prudence practice by not disclosing key assumptions used to determine the recoverable amount of assets. Now DA leaves it to the user of this research report to judge with the 7 highlighted issues. 1. Average return on investment in subsidiaries is way below any of the budgeted expectation, merely 1.2% per annum in last 4 years. 2. Huge advances during financial year 2012-13, to related and unrelated parties by subsidiaries. 3. 94% reduction in stock price. 4. Business taking serious hit in India. 5. Piling up of advances in subsidiaries. 6. No cash flows from subsidiaries to parent. 7. Negative cash from operation at parent and consolidated level. Is the company reasonable in assuming that it had not incurred any impairment loss from April 1, 2012 to June 30, 2013, and equity investments in subsidiaries is true to its carrying value?